All right. Welcome to this week's show, TSP Weekly Podcast.
All right.
What you got
It's
for
another
us,
big
Jay?
week. And I cannot believe the resilience of this market. We've basically been more or less going sideways for the past 3 weeks, but the resilience of this market is pretty unbelievable given the announcement of new tariffs on Europe and Canada, and all this talk about potential firing of the Fed chairman. The fact that the market is maintaining, basically all-time highs is kind of unbelievable. But we're going to get into all that.
I think it's because nobody believes anything anymore.
Yeah, I think that, what is it, taco? Like Trump always chickens out? That is the moniker of the week.
I don't even think it's, necessarily just about Trump. I just don't think anybody is taking any of this. And we tend to talk a lot more about fundamentals now than we ever have, right? All this economic data, all this thing, Powell, blah, blah, blah. And really, at the end of the day, doesn't matter. All that matters is that chart and where the price is. And so the price is telling us, I think, just my opinion, that the market doesn't care about all that, bibbity bop. The only reason I even look at it is because I care personally about certain companies and stocks. But if you didn't, and you shouldn't, if you're just talking about the TSP, the S&P 500 doesn't care. Like it's obvious if you look at the chart. I shouldn't say they don't care. That's not the right way to put it. They don't believe that what is being said, the blah 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 noise, is making any difference, and therefore they're reacting in a way that says, I believe something different, or I believe the result's going to be different, right? So that's all that matters, is what the market does, not what the chatter is. So
what makes it difficult for investors, if you're watching Bloomberg and CNBC and all that, the disconnect between the fundamentals and the technicals right now is so extreme that you're hearing a lot of fear, and fear gets much worse on the one hand, and on the other hand, you're seeing a lot of greed, because the technical guys are looking at the charts going, this thing's going to explode to the upside. But the fundamental guys are looking at it going, this thing's going to roll over any minute.
Well, hopefully the people have started listening to us and say, don't watch Bloomberg or CNBC, because I stopped watching them. I mean, there's certain things I like their I like certain shows on Bloomberg, right? So like their digital assets, kind of crypto take on some things and some very specific things. So I don't mean to bash Bloomberg or anybody in particular, but I'm not staring at it all day listening to them fill in airspace by talking about blah blah blah, and whether Trump's going to fire Powell. Like if he fires them, I don't know. I mean, I'm looking at the market, right? I'm looking at the S&P 500 right now as we record this because it's Friday, and market doesn't care. I mean, that's what it's saying. I don't know if it doesn't care, but
I can't remember if it was Wednesday or Thursday, but one of those days there was a leak, and supposedly Trump had a letter that he was floating to some Republicans at some dinner, and it talked about firing Powell, and I guess he was trying to get a temperature of the room, whether or not they thought that was a good idea, and that got leaked out, and that caused a big drop, like intraday that day. But then Trump comes back later and says, no, that A, there was no letter, and B, I have no intention of firing Powell, and the market came right back up.
Yeah, another reason not to look at intraday, because we only care about closing prices in the TSP. Yeah. So if you're staring at intraday and you're managing your TSP, you're doing it wrong. So my advice would be not to look at any of that, because look at the closing price, see where it's at, see how it responded, and really, more importantly, just look how it responded for the week. And then that's going to tell you what the market is actually doing versus what everybody thinks it's going to do. Huge difference.
It is such a fine line to try to make the distinction between making decisions based on the crystal ball, right? All the news things make you think, okay, well, if this is happening, then I expect this to happen next. And as soon as you start thinking that way, it's crystal ball mentality. If you just turn back around and look at the trend of what's happened, and wait for a break in that trend, then you can make a reasonable, decision. But until the trend breaks, and we'll get to it, but the trend hasn't budged. There's plenty of things that should have made it break by now, but the fact is it hasn't.
Yeah, honestly, I mean, like all that stuff you just described is like so foreign to me after we've been doing this for so long that I don't even operate that anymore. I just don't. I mean, the only way I know how to operate is looking backwards. I don't know how to look forwards anymore because it doesn't. I mean, you're predicting the future. Now, I'm not against probabilities because I'm an analyst and I do believe in probabilities, right? The probability that X is going to happen, but those are based off data, not market opinion on TV, right? So if the Fibonacci, numbers say that it's very likely, highly likely, or highly probable that this is the next, resistance level or support level, well, I'm going to take that into account, right? But that's data, that's facts, that's not opinion. Right. And so I think that's where the line comes in is if you start to listen to opinions so much that it drives your predictive actions, you're going to fail. I mean, I've watched it constantly and I've become what I think is like a good student of it to say that you can only look backwards. You can look at current, right? But in the TSP, what's the value of looking at the current price? There isn't one. Tomorrow, you look at today's price and last week's price. That's the best you can do. All right, let's get into the podcast.
Yeah, we're gonna actually get to something that you just said about Fibonacci's and targets and stuff. So, all right, so we'll look at what happened this week. CPI, PPI, and tariffs. We're gonna take a look at the new iFund versus the old iFund because there's still a lot of understandably, there's still a lot of confusion about what the new iFund is. And then the bonus chart is XLF, which is the ticker symbol for financials, the financial sector of the S&P 500. And that kind of relates back to what you're just talking about what the historical data says versus what opinions can be. And then the TSP fund charts. So we've been talking about bond auctions a lot. By the end of the year, the Fed has to roll over about 25% of the federal debt. And it's been holding bond auctions really frequently. So we had another 3-month bond auction this week, and the rate at the close was 4.245 versus 4.255 last week. So the lower we can roll over debt, the lower the rate is, the less we're going to add to the deficit. So as long as we keep seeing this number lower than the previous week, that's a good thing. So we saw that in the 3-month bond auction. We also saw it in the 6-month bond auction. Okay, so the short end of the curve, as they call it, the short-term bonds, the rates are coming down a little bit. And this is the actual bond market. This isn't when they say, is the Fed going to raise or lower rates? The Fed lowers what's called the Fed funds rate. But the bond market, what things actually sell for in the bond market is how the price gets set. So on Tuesday was a big day. CPI is the consumer price index. It's the Fed's favorite inflation index. Okay, the CPI and the PPI are the two most important inflation indexes. So month over month, CPI comes in at 0.3, which was in line with analysts' expectations. Year over year was 2.7%, which also was in line with expectations. So inflation, right? The goal is 2%. And we're at 2.7% still. So not making a lot of progress recently towards the 2% level, but certainly not going up. We also had New York State Manufacturing Index. It was up 5.5 versus negative 16 last month. And the S&P 500 was down 0.4 on Tuesday. But the New York State Manufacturing Index, anything below 0 is manufacturing is contracting. And 1 month does not make a trend, but it's a big improvement from the last 4 months. That's kind of telling us that if manufacturing if this does continue higher, that's a big plus for the economy, right? So it's all kind of goes to what we're going to be talking about in a minute, tariffs and the effect the tariffs have had so far. If you look at it based on the New York Manufacturing Index, tariffs haven't had an effect, right? Then Wednesday we get 30-year mortgage rate. It jumps to 6.82% from 6.77% last week. New applications fell 10%, right? Because rates went up, and so it's harder to get a loan, so fewer people applied. The 30-year bond, which is the closest to what mortgage rates are going to be, went over 5% this week. And so I would expect the mortgage rate is going to go up next week. It wouldn't surprise me if it went over 7%. So housing is going to become more of a focus in the news here going forward. PPI was flat, was 0%, versus being up 0.3% last month. So PPI is the producer price index. It's inflation of raw materials that come in for producers to make things, which ultimately translates to the consumer price index, right, when we buy the things. So there's the buying side and the producing side. PPI was flat, which is essentially a negative number relative to last month being up 0.3, right? Which again means that there's no inflation being felt on the producer side. So no effect from the tariffs on the producer side, which is amazing, right? Nobody expected that. PPI year over year is 2.6% versus 3.2% last year at this point. And then the S&P is up 0.32%. Thursday, retail sales are up 0.6 after being down 0.9 last month. So that's a huge move for retail sales. And then initial jobless claims at 221,000 versus 228,000 last week and 235,000 forecast. So again, the employment numbers continue to be really strong. And the S&P is up 0.54%. And then on Friday, we're going to get housing starts and Michigan consumer sentiment data. And I definitely expect the consumer sentiment data to come in positive because all the other numbers are positive. This was a week that everybody was expecting to see the effect of tariffs through inflation, and we're not seeing it. So CPI, PPI, tariffs, and the economy. I just wanted to throw out a couple of things that are going on. We got we had a 90-day pause, right? The administration said they were going to do a 90-day pause on tariffs, and maybe that's why we're not seeing big spikes yet in the inflation data. But supposedly now August 1st is the tariff deadline. So everybody's going to have to start paying as of August 1st. This week we got a new tariff at 35% on Canada and 30% on the EU. And we had talk of firing the Fed chairman. And still the market pushes higher. But it pushes higher for some good reasons, right? CPI is the annual inflation rate in the US accelerated for the second consecutive month to 2.7%. In June. It was the highest level since February, up from 2.4% in May, but it was in line with what expectations were. The core inflation went up to 2.9 from 2.8, but analysts expected it to be 3%. So that analysts are anticipating inflation going up, and it's certainly not going up as fast as they're anticipating it. And then monthly core CPI rose less than anticipated by 0.2 compared to the forecast 0.3. And 0.1% in May. So basically, yeah, it ticked up a little bit, the inflation rate, but it's not spiking like what a lot of analysts and pundits on TV are talking about and expecting. It could. I mean, after August 1st, we could start doing like this, but right now it's not. So that's a positive, right? And then PPI is the other side of that. It's the producer inflation. And we said it went from 0.3 last month down to 0 this month. So you would expect to see inflation coming into PPI before it goes to CPI, right? Because if inflation rises for the producers, they're going to produce products at a higher cost and pass that cost on to consumers, which would be seen in the CPI. But we're not seeing an increase in inflation on the producer side. So for right now, I mean, again, that can change August 1st, right? But for right now, it's headed in the right direction. And then if you compare manufacturing, which there are two sides to the economy, right? The services side and the manufacturing side. This is the New York Manufacturing Index and the Philadelphia Manufacturing Index. So for months, right, for the first half of 2025, both of these were below that zero line. And then this month, both of them had a big uptick, which is positive, right? The manufacturing index now is above zero on both of them. So is that a result of onshoring, you know, and what the administration hopes to have happen is that bringing more onshoring into the U.S. increases production in the U.S. So is that what we're seeing? 1 month does not make a trend. I have no idea if it'll continue, but if it does, if inflation continues not to go up, these manufacturing index numbers should continue higher. And if that happens, the market continues higher. It's kind of amazing, but you can see what's actually happening in the data versus what people think is going to happen on TV. And then this last one on import prices. So it makes sense. Import prices are up, you know, a little bit, but they're certainly within range of all of this. And you would expect input prices to go way up as tariffs go into effect. So maybe August 1st, you know, when we get the August numbers, maybe it's way up here. It's entirely possible. But right now, the input prices are just not rising. Okay. So the new iFund, still a lot of questions about the iFund, and it's absolutely understandable. The old iFund was the Europe, Asia, Far East Index. The new iFund is the all world ex-US, ex-China, ex-Hong Kong. I pulled this is the data sheet from MSCI. So I couldn't put the link down here, but if you Google MSCI ACWI, it'll pull up the MSCI website, and you can click on the paper that talks about this. But for us, the problem for us is that this index was created, I want to say in 2023. I think it says on here somewhere. The index isn't really used by other funds. I don't know that it was made for the TSP, but nobody uses it. And so because nobody uses it, you're not going to find a ticker symbol on stockcharts.com or TradingView or any of the other platforms. You can find it on Yahoo Finance, but you can't really manage the charts on Yahoo Finance. So what they actually did, which was kind of good for us, because the MSCI All World ex-US, okay, so that would include China and Hong Kong, right, is the yellow line. So if you do All World ex-US, you get this yellow line, which is pretty close to the blue line, which is the actual ex-US, ex-China, ex-Hong Kong. And the ex-US can be found on TradingView and stock charts, okay? So since this is so close, the ex-US is so close to the ex-US, ex-China, ex-Hong Kong, it's the closest ticker symbol that you can use, and it's better. It's a better approximation than the Europe, Asia, Far East Index, which was our old iFund. So the ex-US, okay, this is the yellow line we're talking about. The ex-US excludes the US. The relative rates weighting of China and Hong Kong in that index are higher than they would be if it was the full world. So basically, the weighting of China and Hong Kong combined is about 10%. Okay. So this is a chart of the all world ex-US. Okay, so the ticker symbol is ACWX. That's going to be the closest ticker symbol we can use right now to the new iFund, ACWX. That includes China and Hong Kong. Okay. China and Hong Kong combined are about 10% of the all world index, ex-US. So if China and Hong Kong start really taking off, you're going to see that the ACWX goes higher relative to the I fund, right? Because the I fund does not include China and Hong Kong. And if China and Hong Kong start falling a lot, then the ACWX will underperform the new I fund. Does that make sense?
Are you asking me or everybody that's watching? I mean, here's the thing. Yes, it absolutely makes sense, but it still doesn't make it easy to just pull it up and figure it out. And that's not going to happen until they make a ticker symbol for this fund, because you're just going to have to guesstimate.
Right. It's close. It's close, but it's not easy. And I just wanted to point out that if you are tracking that all world ex-US index and you're wondering why the I fund isn't, it's going to be very close, because China and Hong Kong are only 10% of it. So variations in China and Hong Kong will result in the variations you see between the US. Really wanted to, you could just follow the EFA, which is the old I fund, because this chart's going back to the bottom at COVID, and as you can see, since the bottom in 22, the Europe Asia Far East Index has actually outperformed the all world ex-US, but they're close, right? You're not going to be all that far off if you use the EFA or if you use the ACWX. So in terms of the trend, you can use either one, but if you're trying to get really, really specific, we just don't have a ticker symbol for the new I fund. Okay, so bonus chart is XLF. It's the financial sector of the S&P, and it is the second highest weighted sector on the S&P 500, right below tech. So what I basically did here was, we had bank earnings this week, and so that's a big part of the financials, right? The big banks, and there are a lot of really good analysts that say the banks lead us up and the banks lead us down. Tech, which is the highest weighted, can be really volatile, but if banks are doing well, the overall index tends to do well. If banks are not doing well, the overall index is not doing well. And so if you look at it, if you forget about what people are talking about the banks, and you just look at the history of price movement, if we start down here at the bottom from COVID, and you do a Fibonacci extension of price, so this is the top before COVID, and this is the bottom after COVID, and we use the Fibonacci extension tool. Once we get above this prior high, once we get above this high, then we're looking for how high price can go. The most common target is that 1.618 extension. Okay, so let me just go back 1 second. This is the top before COVID. This is the bottom at COVID. As we're looking at the rally that comes off the bottom, this is the price is what's called retracing at this point. It's retracing this move down. So the first retracement level where we expect, if price is going to roll over, right, it's going to roll over at that 38% retracement level. That didn't happen. It blew right through it. The next one is at 0.618 retracement level. It got there and gapped above it. That was a huge indicator that the market is going to keep going. The next one is the prior high, which we got you right here and had that pullback. But once we gapped up and got above that prior high, now you're using the tool, rather than trying to figure out when or if the market's going to roll over. Now, once it gets above here, you're looking to see how high it can go. And the most common target on the upside is 1.618, which we got there, churned for a while, and then began that 2022 decline. So the next one was the top, right before the 2022 decline, and the bottom in October 2022. So we're looking for a retracement, and we got it at that 0.618 retracement level. Market pulls back, churns, comes back up and tests it again, and then broke above it. Came up to the prior high, which was here, churn for a while, right? We're looking for resistance or a rollover. So we get resistance there. And then once it got above it, now we're looking for an extension. How high can it go? Goes to the 1618. That's where it got to, did a lot of churning, and then had that pullback at the beginning of this year. So the next one is the top, February 19th was the top right there. We had the bottom in April. We pulled back, got through the retracement levels, and we just broke above that prior high. So now we're using the tool to look at extensions. So the extension target is 1.618. So we're up here at 58, right? So we're looking for price on the financials to come in up here at about 58. So what that's telling us is if the banks lead the market, we're looking for the market to continue higher, and this is the target for financials. The other interesting part of this pattern really is that we came off the bottom in COVID, pulled back right to the prior high, and that was the low. Then we came off the bottom in 2022, got to the high, pulled back to the prior high again, right? So if we rallied out of that. If we get up here to the 1618, the likely pullback is this prior high, right? And that's the value of technical analysis and the value of using just this one tool, which is Fibonacci extensions and retracements.
And you didn't need to watch or listen to Bloomberg or CNBC or anything to figure that out. You could literally be in a cave, but you would have to have an internet connection to get that. But I'm just saying.
That's what you're looking at right now. I'm in a cave with an internet connection, and that's what I'm doing.
Yeah. You don't need to listen to 73 different analysts. I think that's probably. I would put my money on the fact that that's usually what confuses people most is they listen to too many people. There's nothing wrong with listening to a few analysts that kind of speak your language, that kind of or make sense to you. But even then, they can take you down a rabbit hole, and you can start to question the data. You can start to question the price. The moment you start to question what the price actually is where it starts to fall apart. Because as soon as you start to believe, I used to use the word hope a lot. If you hope that it's going to go higher, well, good luck with that. If you believe it's going to go higher, good luck with that. If it goes higher, then it went higher. That's it.
Yep.
That's it. Now, having those little lines in the sand, I'm going to bring it back up here. Having these little lines in the sand help you, and that's how I think of Fibonacci retracement levels or Fibonacci levels in general, is having nice little lines in the sand. Like Jerry said, a very simple way to look at it is, okay, let's say it hits that top level, and then all of a sudden, if it does start pulling back, well, then there's a high probability based on lots and lots of math and data that it's going to come back down. That's not a guess. That's not I believe. That's not a hope. It's math, and there's a good possibility. Now, can that not happen? Absolutely. It's just very highly likely and highly probable, which is what you want to base your decisions off of. And so, what that's helpful for is, now we can't do like stops in TSP, but you can do manual ones, mental ones, and say to yourself, okay, if it goes past this line or this particular place, I'm out. That's my next move, right? And I already have that pre-planned. Don't wait for it and then go, oh, should I do this? No, make it. And then when it happens, you can go, okay, well, that was my line, so I'm out. And then you need to know where your next line is to where you get back in. These are very simple principles that we've been teaching, since the beginning. And a lot of times we start to get kind of, especially on the podcast, we start to get a lot broader in all these different, ways of looking at the market and data, and it really should be very simple. Pick the stuff that talks to you, right? We have a particular stack that we use a lot, right? Jerry's talked about them in the past. We got CCI, RSI, MACD, the different moving averages, and we kind of look at all those. And if it hits all these things, there's a high probability that the trend has changed. Doesn't mean it's not going to change the next day. It just means that there's a high probability it's just changed. And so that all starts to become very simple to where you don't have to listen to all these different analysts and listen to their versions of the crystal ball.
Yep. No, 100%. Let me just point out one thing on this. Go back to that chart. These are projections, right? And it doesn't always work. So we do have one on here that didn't work. We were rallying into the 2018 top, right? We had a good pullback and then a rally, and we got above the prior high. So if you did a Fibonacci extension, retracement and extension from this high to this low, we got back above the high. So if we had it, you would be looking for the 1618 extension of that. And then COVID came along. So you cannot ignore that. This is a weekly chart. So that move down, the gap there, and that move down in 1 week, you can't ignore that, right? So this would have been a failure of that expected projection. So that's why, when Colin was saying we take a lot of things into consideration, moving averages and RSI, CCI, MACD, those things. This Fibonacci tool is a really valuable tool, but if it's the only thing you're looking at, it's not telling you what's actually happening. It's a guide. It's giving you a really good roadmap, but every once in a while, there's a snowstorm or a tree falls in front of you or whatever, and you get something, or a pandemic, and you get something like that.
Yeah. And, we always use the term lines in the sand. I think that comes from the military. I'm not exactly sure. Sand tables, probably. But whatever it is, whatever your, we got to come up with some different ways to explain that. But, your plan A, plan B, plan C, whatever it is. I mean, you need guardrails. And I think those, between moving averages and trend lines that you draw yourself, right? So trend lines you got to do yourself. And all these things are explained. If you guys are, go to our site, we have tons of courses on how to do all this stuff. And you find the ones that work for you, and you really don't need but about 3 or 4 tools. And once you put those together, it starts to become really clear. Like as soon as you have some trend lines and, you don't have to understand the math of Fibonacci to use it. I certainly don't understand it. I tried to, because I usually have a habit of I really want to understand why and how and what it's doing. And I gave up. Because I don't care. I just draw it, on TradingView, and it works. It gives me some, gives me some probabilities, some ideas of where it might go next. And then, I'm not banking on only that. Like Jerry said, you can't only use Fibonacci. You have to use other things. Some people like oscillators, right? Some people like, again, whatever it is that speaks to you.
Yep, all good. Okay, so TSP fund charts for the week. So again, we've been kind of in this 3-week consolidation range. So the consolidations basically mean the market's going to break one way or the other. Okay. In the big scheme of things, each one of these ticks is 1 week of price movement. The blue line is the 20-week moving average line, and we have the relative strength indicator at the bottom. So as long as the blue line is trending up and price is above the blue line, the trend is up. Okay. When the blue line rolls over and starts trending down and price stays below the blue line, the market's trending down on a weekly basis. On relative strength, as long as relative strength is above the 50 line, you're good. Price is going up. When relative strength gets below 50, that's when we have all of this. Okay. So right now, we're pretty far extended above that 20-week moving average line. It's much better when we slowly move up, because when we get too far extended, price tends to fall back down to that line, pick it up, find support there, and keep going. But this is where everybody thinks the sky is falling. And in the short term, it does, right? This would be a pretty big percentage drop from 100 to 94, 6%. So it would be a pretty big move to the downside if that happened. And eventually, price will come down and test that rising 20-week moving average line. But for right now, we are in this pretty tight consolidation, and we'll see which way it goes. But there's plenty of room for relative strength to move higher before it gets overbought. S-Fund has been doing really well ever since we got back above that downsloping trend line. This was a huge gap that likely will get filled at some point, but that was a huge move to the upside, and we're not all that far past it. So the next resistance level is the prior high from 2024. As long as rates don't go super high, the S fund could potentially outperform the C fund. It's basically been flat. The ratio between the C and the S fund has been flat for the past few months. Obviously, the S fund has gone straight up off of its April bottom, but so has the C fund. And on a percentage basis, they've done it over that time period basically the same. So it's been flat. And we have more room to go on the upside on the S fund on relative strength. I fund. So when we pull these charts from stockcharts.com, this is the actual numbers of the actual TSP funds. So while you can't go to stock charts or TradingView and pull up the I fund, but these charts we create manually by pulling the data directly from the TSP site into stock charts. So this is a chart of the actual, as of Thursday's close, that was the number. If you go to the TSP site, that's the number for the I fund. It's pulled back a little bit. The dollar, all the news is talking about how the dollar is collapsed and everything else. Yes, that happened in the first half of the year. But since the April bottom, the dollar has started to recover. And no one's talking about it yet. I don't really understand why. But as the dollar recovers, the I fund goes down. And that's why we're seeing that pullback in the I fund while the C and the S funds continue higher. The I fund is also a lot closer to being overbought than the C and the S funds are. So it doesn't, there's no indication that it's rolling over or crashing right now. But every time we get, to really overbought levels, that tends to be the top. So the I fund, I would argue, is not as good technically right now as the C and the S funds are. And the F fund is really going to be the important thing going forward. If the Fed is worried about inflation going up because of tariffs, if inflation goes up, the Fed might have to raise rates, right? But if inflation goes up, interest rates are going up, it means the F fund is going down. If the administration gets its way and the Fed lowers rates, if inflation comes down and the Fed lowers rates, the I fund goes up. If the stock market crashes and the Fed has to cut rates, then the F fund spikes up. So with all that kind of said, you got a high, and a high, and you have this kind of triangle formation happening. So if we get a big breakout and a close up here somewhere, it's very likely that the stock funds are crashing and the F fund is taken off. So we really only use the F fund as a tool. The G fund obviously is if everything is going down, the G fund is the best place you can be. But there are times when the F fund can go up drastically while the stock funds are falling. And if you can stay on top of it, the F fund can be really valuable during those times. But we are not there yet. And then the G fund always goes up and to the right. I mean, there's nothing wrong with the G fund. You're getting a pretty good rate of return. if you're concerned about the economy and all that, the G fund there's nothing wrong with being there, but the trend in the stock funds is up. And as long as that trend is up, the rate of return in the stock funds is going to be better than the G fund. Questions?
As always, if you have any questions, you can put them in the comment section wherever you found the video. If there is no comment section, just send us an email, support@growmytsp.com. Support team will get it over to us. And hope you guys have a great week. And we are out of here.
Out of here.